try and demonstrate what I've just explained, I've created this chart which shows you exactly how monetary policy has an effect on the stock market. I have overlaid the US prime rate on the S&P 500 returns from 1954 through to October 2009. What is the prime rate? The prime rate is the cost for business or consumers to borrow money. The rate published is usually the rate for favored customers with a lower risk profile. If your risk profile is higher, you may have to pay a higher interest rate. The prime rate is important because if a company has 80% of its capital from bank loans and it has a 5% profit margin, imagine what would happen to the company's profits if interest rates went from 5% to 15%. The company's profit margin might be reduced by 2% or nearly halved if all things remained equal. Therefore, a company may seek to maintain a profit margin by reducing its costs and attempting to pay back some of the debt. More often than not, reducing costs often comes in the form of reducing people. Therefore, unemployment increases. Companies could also increase the cost of the product or service they provide. However, this might lead to fewer sales, less profit. Therefore, they would need to shed staff anyway. We can see clearly in this chart what the biggest influence over the stock market direction is. The mid to late 70s saw stock market stagnation. Then the cost of money was reduced in the form of interest rates. A prime rate above 10% has contributed strongly to a stagnant stock market, at least, or at worst, a period of serious decline. So here you can see the prime rate line. The prime rate here is approaching 5% here, moving on up to 8%, dropping back to 5%, and then mid-70s surging past 10% up to 12%. Then, as the oil shock kicked in the early 70s, you can see here there was market stagnation during this period of high interest rates. So you can see the monetary policy was to reduce the prime rate down to here. And then what happened? We saw a growth or a recovery and growth in the stock market here in the S&P 500. As the market moved onwards and upwards, the monetary policy was changed again, and you can see interest rates were started to increase and went past 10%. Here's the green arrows here are the percentage rate lines for the prime rate. So 5, 10, 15, 20, 25%. So what happened here was then the prime rate was increased up into an unbelievable rate of 20. And you can see here that led to some sideways consolidation and a dip in the market in the early 80s up until about 1983. Then the Federal Reserve decided to start bringing down interest rates, lower the cost of money so that the economy could start to recover and grow again, an expansionary policy. So decreasing, as you can see here, decreasing the prime rate sparked a huge bull market. And that bull market lasted from the early 80s with the shock here in 1987, but then again continued because of low interest rates and a good business environment through to the 90s and then through to 2000, a huge prolonged period of market growth. Here you can see the prime rate was held essentially between 8 and 10% and then decreased even further in the mid to early 90s and was held fairly stable under 10% for a long period of time. So you can see here a prime rate of more or less under 8% is beneficial to business. Of course, the Fed noticed that there may be some overheating leading up to the dot-com bust or the year 2000, and the prime rate was increased to try and provide a little element of stability and cooling for the economy. And what happened? We had the dot-com bust. And as that was happening, the Federal Reserve dropped prime rates to, again, a very low number, under 5%. So by the time the dot-com boom had worked its way out of the system, you could see then, as the stock market was picking up, then the Federal Reserve started to increase interest rates again to try and encourage a slow and stable recovery. And then we had the credit crisis, which involved then, as a reactionary plan, the Federal Reserve to drop interest rates yet again here and bringing them down to almost an all-time low to help the economy recover. So lower prime rates and a stable low prime rate leads to stock market growth, but that also has to be combined with trying to cool down the economy when it blows a fuse and keeps growing unrepentantly. So you can see here periods of very high prime rates or interest rates leads to essentially stagnation in the stock market. The direction of the interest rate moves is very important to the stock market, and you can see here growth, and further growth up to 2000, with the drop in the prime rate, another drop in the prime rate, and the prime rate being held very stable. And then as the market in 2000 to 2003 went through a bust sequence, the rates were brought down, a recovery ensued, and the rates were increased again to try and slow the economy, stabilize the economy, and stop it from overheating, essentially. But something quite different happened here in 2008, which caused one of the most violent global stock market crashes since the Depression. This time it was not the cost of money, but the money supply, the other factor mentioned in our definition of monetary policy. The availability of money was severely restricted because of a lack of trust between the financial institutions. None of the institutions knew who had how much exposure to the subprime market. That was at the time collapsing. Therefore, the banks stopped lending to each other because they never knew if they would get that money back. There was severe mistrust. This drastically reduced lending to business and also to the consumer. And the lending to business and consumer is what drove supply and the demand. This caused a much quicker and more devastating effect in the economy than slowly increasing interest rates ever could. This was akin to someone just simply turning the lights off.